European stock markets are open for trade for the Friday session, and we're setting up for a little bit of red ink, a slight give back for what has been a fairly decent trade so far this week. The benchmark prior to the session has been up about 1% in contrast to US market that has been weaker than that. The Nasdaq, for instance, is down about 1.25% for the trading week. The only market that has been up slightly is the Dow, and that is about 1/3% in the green so far week to date. So these markets here outpacing the US boards so far this week. And if you break it down versus the various different markets, the French stock market up 1.6 for the trading week, 7/10 on the FTSE, and about 1/3% on the German stock market. So it is a setup today where it could be challenging because of that outperformance. So far we're giving back about 0.5%. It has been a stunning week. We've had a lot of data coming through in the last 24 hours, but it has also been very thick on the ground on earnings season. So there's been a lot of stock trades to play this week. Let's get into what we're seeing in terms of some of this red ink and just how wide it is. Although I can see one patch of green, and that is around UBS this morning and the decision to remove that safety net from authorities that they took on in the acquisition of Credit Suisse. At the top, we've got telcos, and that is one green arrow this morning. At the bottom, we've got basic resources. The sector play is travelling weaker and giving up close to 1% from the outset. Glencore, Antofagasta, Rio, Anglo American, all weaker trades in the session this morning. Oil and gas. We were talking about the gas market and some concerns around strike action in Australia, and you can see the market in the red today, despite some green that we saw on the natural gas prices in Europe yesterday. The oil and gas segment, every stock in that basket is in negative territory. Along with autos, similar view, broad-based sweep weaker for that sector. The likes of BMW towards the bottom of the basket, we're seeing losses there of just over 1%. Technology names, they travel weaker too. We're just talking about the big foundry out of China today and numbers that it's produced. The supply chain here in Europe this morning starts on the back foot. Household goods down 0.75%. It has been an area of interest again for those luxury plays this week, but this morning giving back territory. Construction as well, along with healthcare, they are weaker components. Industrials, we're down 0.6 for the huge basket of stocks. Chemicals down 0.5%. Modestly downbeat for utilities. It has been show and tell season for some of those wind turbine players this week, but red arrow there too, along with insurance stocks. Again, another big reporter. We've had a lot of reports crossing from this sector. Banking stocks giving back some territory. We're down by about 0.25%. Telcos giving up the top spot, and that is down to financials thanks to UBS today as the news flow has crossed around the Credit Suisse safety net that it took on. The stock has spiked 3.7%. That is managing to drag the rest of the financials basket into positive territory. Let's take a look at what we're seeing at the FTSE level. We are down. We've given up 43 points, so almost 0.6%, but crucially, we are holding around that 7,500 mark. We've given up the 7,600 territory. The French market, a little bit more give back to 0.6 in the red, 7,388, and then the German stock market joining the party weaker, 4/10 down. In lockstep, the Italian stock market, similar tune, 0.5%, 4/10 roughly in the red, and we're seeing losses just move on to the charts too for the SMI in Zurich and for the IBEX in Spain. Modestly downbeat versus slightly steeper selling on some of those core markets today. Let's get into that UBS reaction, and it is stronger. You can see the market has given this move the thumbs up. 3.8% bounce, stock now year to date up 17%. It has voluntarily removed the loss protection agreement it had with the Swiss government and Swiss National Bank, confirming taxpayers will no longer bear any risks from the collapse of Credit Suisse. In an internal memo seen by Reuters, UBS says it's confident it will be able to bear the costs and financial impact of Credit Suisse's integration on its own. It added it had repaid, quote, all extraordinary liquidity support created by the emergency law. The 9 billion Swiss franc backstop was agreed as part of the lender's emergency takeover of Credit Suisse earlier this year, as pointing out that the bank itself would have had to have taken on some losses first up before tapping that 9 billion. And all this is a precursor to what we're seeing as earnings, Q2 earnings crossing later this month. The market has had big question marks as to how aggressively it could cut costs, namely from workers, if it still had this safety net in place. Also in terms of just how political it would be still having that intervention by the state there, given that the guarantee was in place. So the market liking this news flow, taking the shackles off, and of course the payout what we can expect in coming years is quite key at this stage as it steps away from the support of the state. More than 4% high now in the stock price. European banks more broadly, and you can see this contextualised by the trade around the rest of the banks. We've got mostly a mixed picture. The gains outsized on UBS versus a modest tick higher in some of the other names, from Deutsche to Barclays to SocGen, and red still for some of the other big names. It's been a big week, as you know, for those Italian banks around the intervention from the state here on the windfall taxes. And it is another downbeat session for UniCredit and Intesa, the two big plays for the Italian banks here. Gilt markets are opening in the UK after GDP growth came in stronger than expected in June, with output rising 0.5% on month. Chancellor of the Exchequer, Jeremy Hunt, said the government is laying the foundations for a stronger economy after growth in the second quarter also surprised to the upside, coming in at 0.2% versus expectations for stagflation. The gilts, two-year gilts, 4.95% is what we're seeing. So slight green on that yield, 4.43 on the 10-year. A look at sterling, we popped on the back of the news flow 127.0908, and we're holding above 127, so it is a tick up of about 0.25% plus on the foreign exchange trade today. Let's get out to Arabile for more. Arabile, there are all sorts of reasons to be downbeat, namely the very aggressive path of monetary policy and very high inflation rates still, but the data has surprised today.
It certainly has, right? And it's really just grown significantly. Yes, it's the services part, which many